Federal Reserve rate cut unsurprising in the context of China and European devaluations and weak inflation. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about the Federal Reserve. They're cutting interest rates. They're from 2.5% to 0.25% to 2.5%, down to 2% to 2.25%. They have the federal funds rate. This is the interbank lending rate that they set. So it's a key interest rate in the U.S. economy, and it's set by the central bank. It's the so-called low rate. And this is they're moving it down a quarter of a point from where it was. And they just announced that on July 31. And they're citing lower inflation as the principal cause of that. They're saying, quote, overall inflation and inflation for items other than food and energy are running below 2%. And if you look at the CPI, surely enough, it's come in at 1.6% for the past 12 months as of June. And all items less food and energy, they're coming in at 2.1%. But I think here the key item is that overall inflation is at 1.6% when you include food and energy. And that's certainly less than 2%. The decision was also coupled by a decision by the Fed to stop selling securities back to the market, which it was coming sooner than expected. Looking at the Federal Reserve statement here, they say the committee will conclude its reduction of its aggregate security holdings in the system open market account in August, 2 months earlier than previously indicated. This is actually really interesting. Since September of 2017, Federal Reserve has been shedding its security holdings. They bought a lot of them, U.S. securities and mortgage-backed securities during the financial crisis. What they were saying here in 2017 was that they were going to begin selling these. And so securities held outright was at 4.2 trillion in September of 2017. And in its most recent publication, that was down to 3.6 trillion of securities that it held outright. So you had a reduction of about 621 billion of MBS and U.S. Treasuries, and so that's if those who thought that the economy was kind of slowing down a little bit because of these jettisoning of treasuries and mortgage-backed securities, that it was pushing down interest rates. Well, they're getting what they want now. The Fed is cutting interest rates, and they're stopping the program to sell the bonds. Now this comes in addition to the low inflation. It comes as China has continued to devalue the yuan. It's been devalued another 3% since President Trump did some more tariffs. He's doing more tariffs today, with going on 10% of the remaining $300 billion of Chinese goods. We were already at 25% on the other $250 billion of Chinese imports. So, and you've seen a bit of a devaluation ongoing by China. And they're responding. They want, when we institute tariffs, they want to devalue their currency, and so now it looks like we're responding in kind as well. The euro has also talked about lowering interest rates, so this could also be viewed as preemptive by the Fed in response to the European Central Bank saying that they might want to cut interest rates as well. Which you might expect if you're mid-cycle or even towards the end of the cycle, that interest rates are going to begin to be cut. So hopefully we're not at the end of the cycle, because then that means a recession would be around the corner. But either way, you can see that the Fed's decision could be viewed, if you're looking at China and Europe, as a competitive devaluation to potentially stave off deflationary forces coming from overseas devaluations with economies coupled to ours, such as China. So President Trump, he's weighing in on all of this. He's been very critical of the Federal Reserve and the policies they've undertaken. Americans for Limited Government, we have been too. We think that selling back the bonds, well, they should have begun that years ago during Obama's terms of office. And in terms of raising interest rates, they should have done that back in at least 2015 when the economy was starting to speed up a little bit again. I think that they bought too many bonds and then they held on to them for too long, and they kept interest rates at practically 0% for way too long. So President Trump, now he's saying what the market wanted to hear from Jay Powell, he's the chairman of the Federal Reserve, was that the Fed was going to beginning of a lengthy and aggressive rate cutting cycle that would keep pace with China, Europe, and other countries. As usual, Powell let us down. At least he is ending quantitative tightening, which shouldn't have started in the first place. No inflation. We are winning anyway, but I'm certainly not getting much help from the Federal Reserve. And looking at Trump's comments, okay, yeah, I think that he should look closer at what the Fed said here. In their statement, they do say that as the committee contemplates the future path of the target range for the federal funds rate, it will continue to monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion. So if the economy looks like it's softening, the Fed's saying here that they will cut rates further. So not cutting rates would actually be a show of economic strength from their perspective. Trump's saying, no, they should be forecasting these future rate cuts. So they have a little bit of a disagreement there. As a note, the move by the Fed also comes amid key interest rate inversions. So if you look at the 10-year federal funds rate, 10-year Treasury to the federal funds rate, it's been inverted since the end of May, or towards the end of May, and it's stayed there ever since. And so the Fed was sitting by watching as the 10-year Treasury interest rate went less than the so-called low interest rate of the federal funds rate, and it's been there for 2 months now. And the 10-year 3-month, which is the 3-month Treasury, is traded on markets, but it too inverted right about the same time, right towards the end of May there. And this has been, people are saying, oh, wow, this is a recession indicator. The 10-year 3-month, oh, every time that there's an inversion, it'll that forecasts a recession later. But other variables like that, like the 10-year, 2-year spread, has not inverted yet. And you would expect to see it invert prior to a recession, but it hasn't done so. In any event, it looks like the 10-year 3-month may be curing itself of its inversion, and just as the Fed was making its announcement. So this could be a false indicator. Sometimes you see the rate invert, and then it will pop back up briefly for a few months or a year, and then invert again prior to a recession. So it does look like we're heading towards the end of the cycle, the economic cycle. How close we are to that, that's anyone's guess. But the inversions, if they're rapidly cured here with the Fed's new posturing, then it may be that they're forestalling the end of the cycle by acting as they are. And you don't want to see the rates fully invert, or for the Fed to just say we're going to bring the interest rates down to zero immediately. That's what the Fed does in a recessionary period, where they'll cut rates as the economy is softening, and to ease lending conditions. I think that in this case, President Trump should be careful what he wishes for. You don't want to see a rapid rate cuts. And I'll leave you with the close here. The Fed doesn't have much room to cut rates, so when the push towards 0% begins again, we might be able to safely predict that the next recession is imminent. If, however, the Fed pauses from its current position, they leave the rate, they cut down 0.25%, and then they leave the rate where it is, then that could mean we're still in the middle of the business cycle. All of which and so Trump should be careful what he wishes for, and this all has implications for 2020. A recession would upset the apple cart and make it more difficult for President Trump to be reelected. Naturally, that's why he might be upset with how the Fed has proceeded here. Certainly, the Fed waited too long to raise rates when it could have perhaps safely done so back in Obama's second term. Now we'll never know the counterfactual, but we will know how the economy is doing next year. If the Fed's rate cut gambit pays off, The dollar keeps keeps its footing with the yuan and euro, and the economy keeps growing, unemployment stays low, and inflation ticks up, President Trump might not have that much to complain about next year. The economy's strong. We were looking at that earlier this week. Grew at about 2.1%, a little slower than the first quarter, which grew at 3.1%. But unemployment's really low, 3.7%. 2018 was the strongest year for growth at 2.93% since 2005. Before the financial crisis, you've created close to 5 million jobs since President Trump took office in January 2017. And all this may be holding true next year. And so maybe there's not that much to complain about. The economy is doing pretty darn good objectively. Let's stay tuned, though. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a great day.